What if I told you the most successful trader in history didn't rely on gut feeling, insider tips, or economic forecasts? Instead, he trusted something far less emotional: data, algorithms, and mathematics. Welcome to the world of Jim Simons, the man who built the most profitable hedge fund of all time, Renaissance Technologies. From this point on, you're not merely reading about him, you're walking alongside him. Simons didn't start as a trader. You'd never guess that a former codebreaker for the US government would go on to dominate Wall Street. But that's exactly how this journey begins. Simons, a mathematician by training, once decrypted Soviet communications during the Cold War. His comfort with complexity and his obsession with patterns didn't just earn him accolades in academia, they planted the seeds for something far bigger. His story reminds you, your background doesn't have to scream traitor to be powerful in the markets. In fact, coming from the outside might be your biggest edge. You've heard the stories of Ivy League MBAs poring over balance sheets, of Wall Street veterans analyzing PE ratios. Simons rejected all of that. He believed that market prices followed patterns, hidden patterns, patterns that could be teased out not by intuition, but by statistical models. He started Renaissance Technologies in 1982. And instead of hiring economists, he brought in linguists, physicists, even cryptographers. You realize that what others saw as irrelevant noise, Simon saw as the raw material for a new kind of trading, one fueled not by opinion, but by data. This isn't just about quants, it's about rebellion. Simons wasn't just building a hedge fund, he was launching a mutiny against traditional finance. And like all great revolutions, it began in chaos. His early years at Renaissance were plagued with losses. Models failed, strategies backfired, and the team clashed. You might even see your own trading journey in those moments. When confidence dips, systems fall apart, and nothing seems to work. But Simons didn't give up. He adjusted. Always. You need to remember that he didn't build Rome in a day. Early on, he experimented with currencies, then futures. The process was brutal. The models often didn't align with market realities. But Simons treated failure like data. Each mistake was logged, examined, refined. There's a lesson here for you. In trading, losses aren't signs to quit. They're feedback to improve your system. More than anything, you begin to see Simons' greatest weapon: patience. He didn't chase every market move. He didn't rely on hunches. He trusted the math, even when it failed in the short term. That discipline, that's the foundation of every successful trader. It's not sexy. It's not exciting. But it's what builds wealth over time. The opening of this story isn't about success. It's about commitment. You aren't watching someone who had it all figured out. You're watching someone who walked blindly into the forest, armed with only logic, and decided to chart a path no one else believed in. That's not just inspiring. That's actionable. Because now, as you look at your own charts, your own trades, your own frustrations, you have a new standard. You don't need to be a math genius. You just need the courage to break the mold, the humility to learn from loss, and the discipline to refine your system, again and again. You didn't choose the typical path, and neither did Jim Simons. In fact, before Wall Street ever knew his name, he was knee-deep in Cold War espionage, decoding secret messages for the US government. The lessons he learned there didn't just stay in the cryptography labs. They became the very backbone of a revolution in finance. You trace Simons back to his early academic roots, studying at MIT and earning a PhD in mathematics from Berkeley at the age of 23. This wasn't just a man good with numbers. This was someone who thought in formulas and abstractions, who could see structure where others only saw chaos. And that skill made him invaluable to the Institute for Defense Analyses, IDA, where he cracked Soviet codes as a professional cryptanalyst. But while Simons excelled in that world, his rebellious nature clashed with military rigidity. When he publicly criticized the Vietnam War, it cost him his job. That dismissal wasn't a defeat, it was a redirection. Instead, he took his intellect back to academia, joining Stony Brook University as the head of its math department. But something kept pulling him toward the markets. While at Stony Brook, he began experimenting, dabbling in currency trades with a few $1,000s. He lost. Then he made some back. But most importantly, he started to see what others couldn't. Small patterns in currency prices, repeating behaviors that didn't fit random theory. This was the spark, and then the leap. In 1978, Simons left academia. He didn't fully know where he was heading, but he believed one thing: you could use mathematical models to trade markets. He co-founded Monometrics, the predecessor to Renaissance technologies, with the bold idea of applying code-breaking logic to market data. Imagine the courage that took. There was no roadmap, just a hunch that noise might hide structure, that chaos might veil predictability. Here's what matters to you. Simons didn't wait for perfect clarity. He acted. He ran toward the fog, not away from it. And more than that, he surrounded himself with minds that could challenge his own. This wasn't about ego, it was about the mission. That's your takeaway. If you want to win in this game, build a team not to agree with you, but to challenge you. At Monometrics, Simons started collecting as much data as possible: tick level prices, historical feeds, and other information that traditional traders discarded. Why? Because the more data he had, the more he could test, the more he could find edge. You're starting to see the difference now. While others were drawing lines on charts, Simons was writing equations and running simulations. And he wasn't trading based on headlines. He was trading based on probabilities. Still, it wasn't smooth. The early models failed to adapt to volatility. Their systems could only trade specific timeframes. In short, the vision was there, but the execution was lagging. You know this feeling. You've been there too, when the concept is exciting, but the real-world application is messy. And this is where most traders quit, but not Simons. He doubled down, brought in more data, rebuilt his team, and eventually, they laid the foundation for what would become the greatest money-making machine in modern financial history. The turning point came not from more trading experience, but from deeper academic collaboration. Simons wasn't just looking for another trader. He was seeking brilliance. He partnered with mathematicians like Leonard Baum and James Axe, individuals who had no trading background but were geniuses in stochastic processes and algebraic structures. This was the true pivot. Because the game had changed, it wasn't about making a good trade. It was about building a machine that could make millions of them, without emotion, without fatigue, without bias. Now, as you look at your trading system, ask yourself, are you building a method, or are you still chasing trades? Simons made his bet on math, and though the payoff wasn't immediate, it was inevitable. He wasn't just cracking codes anymore. He was decoding the market itself. You might believe that traditional trading knowledge is your starting point, but Jim Simons proved otherwise. He began building his empire by throwing out everything the textbooks said about how markets behave. There were no charts taped to his wall, no buy low, sell high mantras, just rows of numbers and the burning belief that the market wasn't random. It just looked that way. This belief wasn't common. In the 1980s, most investors thought markets were driven by fundamentals, earnings reports, Fed announcements, geopolitical shifts. But Simons suspected there was something deeper. He wasn't interested in the why. He wanted to know the what. Specifically, what prices did next, regardless of what caused them. This is the turning point for you. Stop chasing explanations. Start searching for repeatable results. Simons and his team began scouring price histories, searching for patterns. They built rudimentary models to identify recurring movements in commodities, currencies, and stocks. And when they found a pattern, they didn't celebrate. They stress tested it, tortured it, and tried to disprove it. You have to do the same. Don't fall in love with the setup. Try to kill it first. If it survives, only then is it real. But the early days were hard. The models weren't stable. Markets would shift slightly, and profits would disappear. Renaissance technologies hemorrhaged money in its early experiments. They even had to close shop temporarily. Now pause. Think about your worst drawdown. That moment where you questioned if this was even for you. That's where Simons was, except he was bleeding millions. The lesson? Even the greatest system builders face collapse. What saved Simons wasn't a better market. It was a better mindset. He didn't blame the market. He blamed the models. He looked for noise in his assumptions. Instead of tweaking endlessly, he rewrote the rules. You need that mindset. If your edge vanishes in a week, it was never an edge. It was luck disguised as logic. Simons began to understand that most patterns weren't strong enough to rely on alone, but when combined with others and sized appropriately, they could stack probabilities in your favor. It was a portfolio of edges, a mosaic of micro advantages. You stop looking for the Holy Grail now, don't you? Because it doesn't exist. What exists is a disciplined search for a handful of repeatable, modest edges executed with ruthless consistency. What made Renaissance different was the refusal to stop at good enough. Every strategy had to be backed by data and improved continuously. The team ran constant experiments, changing timeframes, market universes, execution styles. They created feedback loops that flagged slippage, market impact, and even behavioral anomalies in execution. Sound familiar? This is systematized journaling, quantified reflection, and it's something you need to bring into your own process. It wasn't glamorous, it was grind. Data cleaning, debugging, error correction. It was endless iteration. Simons believed in what you might call engineering humility, never trusting a model just because it worked yesterday. If you're not willing to doubt your system will eventually betray you. Eventually, this discipline started to pay off. The models began to generalize better across assets and time periods. Simons' team learned how to avoid overfitting, how to stop building perfect models for past markets and start building robust models for future ones. That's the discipline that sets apart great traders from lucky ones. When you look back, you see it clearly. Simons didn't invent a single magic formula. He built a factory that produced thousands of formulas, tested them all, and kept only the ones that worked across time. You want to build a trading edge? Build that factory first. You've been told to learn from the best traders. Simons didn't. He built a team of people who'd never traded a day in their lives. That wasn't a mistake, it was the breakthrough. When most funds were hiring Wall Street veterans, Simons went the opposite direction. He looked for physicists, mathematicians, statisticians, people fluent in pattern recognition and system modeling, not market folklore. And you begin to understand why. Traders bring bias. Scientists bring curiosity. His philosophy was simple. If the market was a system, then it could be solved like a scientific problem. So he brought in David Magerman, a computer science PhD, and Peter Brown, a machine learning expert from IBM. These weren't portfolio managers. They were engineers of logic. Your big shift begins here. Maybe you don't need to trade like Wall Street. Maybe you need to build like Silicon Valley. The Medallion Fund was still finding its legs. But Simons knew that without the right minds, it would collapse under complexity. He created a think tank environment, no dress codes, no egos, just relentless experimentation. Meetings were intense, arguments were encouraged, truth mattered more than rank. You realize now, this was a laboratory, not a trading floor. And the culture? Ruthless in its standards, but safe for innovation. There were no heroes, no star traders. Everyone's ideas were tested, and the data decided, not personalities. Imagine your trading room stripped of ego. No more, I feel like it's going up. Just, here's the evidence. Simons also installed a crucial rule, no leaking. Every insight stayed in-house. Renaissance became the Fort Knox of trading secrets. If someone left, they couldn't take their code. If someone joined, they had to commit fully. This wasn't just about control. It was about integrity. It was about protecting the fragile engine they were building. The hires kept coming. Cryptographers, speech recognition experts, theoretical physicists. Names like Henry Laufer and Elwyn Berlekamp joined, legends in academic circles. Their genius wasn't in knowing markets. It was in deciphering complex systems. Together, they treated the market as noise waiting to be decoded. You start seeing it. The market isn't a battlefield. It's a signal buried in chaos. But Simons didn't just give these geniuses freedom. He gave them purpose. Every model they created had to prove itself. And when it failed, they weren't punished. They were expected to learn. You're not punished by losses. You're punished by failure to adapt. That was the ethos at Renaissance. And then came the rise of automation. The models began handling more trades, faster than any human could. Execution wasn't just fast, it was optimized. Algorithms adjusted order flow to reduce market impact. Slippage wasn't a footnote, it was a battlefield. You think you're automating by setting limit orders. They were rewriting the rules of execution itself. That's what happens when you stop hiring traders and start recruiting thinkers. Simons didn't want intuition, he wanted iteration, and this team gave him that. Together, they turned Renaissance into more than a fund. It became a research institution disguised as a trading firm. You can't copy their models, but you can copy this. Build a team that sees differently. Reward skepticism. Measure everything. And remember, The best trading edge isn't in knowing what's next. It's in building a system that thrives when no one else knows. That's how outsiders became the ultimate insiders. By the early 2000s, something strange was happening. Renaissance's Medallion Fund wasn't just profitable, it was consistently, inexplicably, outrageously profitable. We're talking 66% average annual returns before fees. That's not trading, that's printing money. You're in the room now, and it's humming. The fund is fully algorithmic. The code runs trades day and night, thousands of microsignals, millions of data points, orders flying through dark pools and exchanges before human traders even blink. What you're witnessing isn't luck or streaks. It's industrial-grade trading precision. And it's terrifying the rest of Wall Street. While other funds were struggling to beat the market by 5%, Medallion was beating it by 500%. Their models identified inefficiencies too small for humans to notice, but too frequent to ignore. The systems evolved so fast, Simons' own understanding of what they were doing began to fade. But he didn't need to understand the why anymore. He just needed to trust the machine. That's the psychological edge you're beginning to feel now. Detachment. No opinions, no predictions, just relentless execution of edge. The Medallion Fund wasn't about conviction. It was about consistency, about allowing the data to speak louder than the voice in your head. But it came at a cost. Simons shut the fund to outside investors. Why? Because it was too good. The models needed room to breathe. Too much capital would smother the trades. So the fund became a private pool for employees only. You realize the richest trading edge in history wasn't shared. It was sealed off. Let's break down how it worked. The models weren't just predicting price direction. They were also optimizing execution. If a signal said buy, the system also knew how to buy, how to minimize slippage, how to time the order, how to hide it. It was end-to-end efficiency, and every trade was logged. Every result studied, every anomaly investigated. It wasn't trading, it was research. And the feedback loop? It was brutal. If a model degraded, it was pulled. If slippage increased, the code was rewritten. Traders didn't second-guess signals, they refined them. You start to realize your edge isn't just in your entry, it's in your process, in how fast you can detect when something breaks, and how disciplined you are in cutting it. Medallion scaled across asset classes, equities, futures, currencies. It didn't care about sectors or themes. It didn't favor anything. It hunted opportunity wherever the data whispered a repeatable edge. That's the cold, mechanical brilliance you need to channel. Your system doesn't need a narrative. It needs parameters. And through it all, Simons kept hiring, kept testing, kept doubting. He wasn't attached to models. He was attached to truth. And when he saw models drift, he didn't adjust the market to fit them. He adjusted the models or killed them. You come away from this stunned, not just by the performance, but by the purity of execution. Simons' team didn't try to be right. They tried to be adaptive. They didn't look for explanations. They looked for evidence. And they didn't chase returns. They built engines that created them. What would it take for your system to run like that? Step inside the walls of Renaissance Technologies, and you're not entering a hedge fund. You're walking into a sealed vault of secrets, stress, and staggering success. What happens inside the Medallion Fund borders on myth, but you're going to feel what it was like from the inside, because nothing that good comes without pressure. You've heard about their 66% average returns, but what you didn't hear is how hard they fought to maintain them. Every gain made the fund more paranoid. Success didn't breed comfort, it bred fear. Fear of being copied, fear of market shifts, fear of losing the magic. This wasn't a team basking in glory. It was a war room fighting to stay one step ahead. Renaissance operated with military-level secrecy. Offices were badge protected. Logs were encrypted. Algorithms were fragmented so that no one coder could see the full picture. Employees signed some of the most aggressive non-disclosure agreements in finance. You couldn't talk about work with your spouse. You couldn't take your models with you when you left. And you couldn't forget for a moment that leaking anything meant lawsuits, blacklisting, and worse. But the pressure wasn't just legal, it was emotional. Inside those walls, egos clashed. Simons' team was brilliant, but brilliance doesn't equal harmony. Disagreements weren't optional. They were the fuel. Scientists debated over model failures, edge decay, and unexplained slippage with the intensity of courtroom battles. Some called it chaos. Simons called it the process. And through it all, the returns kept coming. They weren't smooth. They were wild, uneven, and often unexplainable. But they trended one way, up. And that meant the stakes kept rising. Medallion was managing billions now, and every decision moved markets. They had to start trading in the shadows, spreading orders across dozens of brokers, using algorithms to disguise intent, and monitoring trades in real time for even the slightest friction. It became clear. The game wasn't just about having edge, it was about keeping it invisible. That's the cost of being the best. You stop trying to win trades. You start trying to win silence. Inside Renaissance, there were factions. Some believed in shorter-term models. Others pushed for longer holds. Some argued for increased leverage. Others screamed about risk. Simons navigated these internal storms like a conductor. He wasn't the most technical anymore, but he understood people. He knew when to nudge, when to step in, and when to let conflict burn itself out. You begin to understand that this is a psychological game, not just with markets, but with yourself, your team, and your systems. The deeper you go into consistent profitability, the more fragile everything becomes. You felt it. After a winning streak, your expectations grow. Your grip tightens. Your fear of breaking the system starts sabotaging it. Simons fought that too, not just with systems, but with culture. He encouraged doubt, celebrated revisions. He made it okay to be wrong, as long as you learned quickly. Because in an environment where returns defied belief, you had to anchor yourself to something stronger than profits. Process. So yes, Medallion made money, obscene amounts of it. But they also built walls so thick, no outsider ever saw how. And inside those walls, they fought harder, stressed deeper, and feared more than you could imagine. If you want that kind of performance, ask yourself, are you ready for that kind of pressure? You've made it through market volatility before, but imagine your system failing while managing billions. That's what Renaissance faced. Medallion wasn't immune to chaos. It danced on the edge of disaster more than once. And if you think your drawdowns are painful, wait until you see what near collapse looks like when billions are at stake. Start with the Russian financial crisis of 1998. Markets around the world were in turmoil. LTCM collapsed. Liquidity vanished. Algorithms built in calmer times began misfiring. Correlations broke. The trades that always worked suddenly didn't. Sound familiar? Simons' team watched in horror as the models spiraled. They were forced to reduce risk fast, but their size worked against them. Every exit sent shockwaves through the market. The models were right on paper, but the market wasn't rational. It was panicked. And that's a brutal reminder for you. The market doesn't reward correctness. It rewards survival. Simons didn't cling to conviction. He adapted, and that saved them. But the pressure cracked things inside Renaissance. Tensions flared. Trust eroded. Some quants left, angry that their work was being second-guessed. Others demanded that Simons give up control. You realize something vital here. Building a great system isn't just about logic. It's about leadership when everything is falling apart. Then came the dot-com crash. Most funds were devastated. But Renaissance saw it coming. They didn't predict it. They just saw the anomalies pile up. Overbought signals, volumes that didn't align with historical precedent. Their models flagged warning after warning, so they cut exposure. They protected capital. And when the market collapsed, they were on the right side of it. Not because they had a crystal ball, but because they had discipline. The real threat came from within. As Medallion grew more profitable, envy festered among outsiders and insiders. Some employees felt underpaid. Others hated the secrecy. A few wanted credit. Lawsuits followed. Books were threatened. It was a full-on cultural breakdown. Simons wasn't fighting markets now. He was fighting mutiny. He responded the only way he knew: rebuild. Strengthen the incentives. Increase transparency inside the walls. Tighten legal defenses. And keep the machine running no matter what. This part of the journey reminds you of something powerful. Your biggest threat might not be the market. It might be the people closest to your system, your team, your partners, even yourself. Simons weathered all of it, not with heroism, but with systems. He didn't make big bets. He made scalable, adjustable strategies. And even when the world turned upside down, he had room to maneuver. The takeaway for you? Resilience isn't reactive, it's built in. When things go wrong, and they will, it's not about courage, it's about design. Simons didn't win because the market made sense. He won because he built something that could bend without breaking, that could shrink when needed, that could pivot when pressure mounted. And the next time your system is under stress, you'll remember this. The man who solved the market nearly lost it all too. You've been told to trust your system. But what happens when your system starts lying to you? Jim Simons and his team learned the hard way. No model lasts forever. Even the most brilliant algorithm eventually breaks when the market shifts. And when it does, clinging to it becomes a liability. This is the sobering reality Simons had to face. Renaissance's models worked until they didn't. Regime changes, new competitors, government policy shifts, market structure evolution. Any of these could quietly poison an edge. But the hardest part wasn't spotting the decay. It was admitting it. Because when you've built something so precise, so effective, your ego ties itself to the model, and your greatest risk becomes pride. So, how did Simons navigate this? With brutal honesty. Renaissance didn't wait for catastrophe to question assumptions. They built uncertainty into the workflow. Every signal had an expiration date. Every model had a kill switch. You need to hear this. If your strategy doesn't have a way to self-destruct, it will take you down with it. They started tracking model decay, watching as once profitable strategies slowly declined. Then they rebuilt, sometimes entirely. Instead of patching leaks, they replaced the roof. That's the level of clarity you need. If your current edge stopped working tomorrow, would you know why? Would you have the tools to respond? Or would you freeze, caught in hope? The team learned that edges often fade in silence. Not with crashes, but with soft declines. Maybe your win rate drops a few percent. Maybe your drawdowns stretch longer. You justify it. You call it market noise. But it's a signal, a warning. Simons trained his team to listen to those whispers before they became screams. And yet, they never stopped believing in models. They just evolved the way they used them. Rather than seeking permanent truths, they built dynamic frameworks, constantly updated, reweighted, replaced. Their systems didn't aim to be right forever. They aimed to be useful right now. This is the core shift for you. Fall out of love with your tools. Fall in love with the process of questioning them. Renaissance built internal competitions, teams testing new methods against old. Let the data decide. No loyalty, no legacy code sacred. This isn't just intellectual discipline, it's survival. You're probably thinking, that sounds exhausting. And it is. But trading isn't about finding peace. It's about adapting faster than the environment changes. Simons accepted that truth early. You need to, too. And what happened when models failed completely? When entire frameworks collapsed under changing conditions? They paused, didn't panic, pulled capital, ran post-mortems. And most importantly, they rebuilt. Here's what separates elite traders from everyone else. They're not afraid of destruction. They embrace it. Because in every failed model is the blueprint for a stronger one. So the next time your system struggles, ask yourself, are you defending a model or defending your ego? Because if it's the latter, the market will show no mercy. When the money is this good, power always follows. Jim Simons didn't just build the most successful hedge fund in history, he built influence. And with that came politics, responsibility, and consequences. As Renaissance technologies grew in fame and fortune, the spotlight turned to Simons himself. He wasn't just a mathematician anymore. He was a billionaire, a donor, a political force. And suddenly, every move he made echoed far beyond the markets. You might think wealth buys freedom, but for Simons, it brought scrutiny. His support for political candidates, his views on tax policy, his donations to scientific research all became headline material. The man who once wanted only to crack codes now had to answer for the implications of those codes. And here's the kicker. You can't separate your trading life from your values forever. Eventually, they collide. Inside Renaissance, things got more complicated too. Simons eventually retired, handing the reins to Peter Brown and Robert Mercer. Brown stayed in the shadows. Mercer didn't. He became a polarizing figure, funding far-right political campaigns, supporting candidates like Donald Trump, and pushing ideological agendas that shook the country. Employees rebelled. Protests broke out. Some staff quit in moral opposition. The internal tension exploded into public scandal. And while Simons himself distanced from Mercer's politics, the damage was done. The firm's culture, the same one built on trust, curiosity, and data, now faced a new opponent: ideology. You begin to see the bigger picture. Trading isn't done in a vacuum. The profits you make, the institutions you build, the people you empower, they all have ripple effects. Simons wasn't a villain, but he learned the price of success, and he paid it with his name. He tried to balance it. He poured billions into philanthropy, funded autism research, math education, ocean studies. He built foundations, endowed universities, and supported science long after he left trading. He was trying to give back. But public perception is harder to model than market data. You feel that tension, don't you? The higher you climb, the more complicated everything becomes. It's not just about winning trades anymore. It's about what those trades fund, who they empower, what kind of future they build. So what's the lesson? Know what you're trading for. Simons didn't set out to influence elections, but his systems, his wealth, ended up doing just that. Your systems, your capital, your voice, they all extend further than you think. Trading mastery gives you control, but it also gives you responsibility. And if you ignore that, you risk building something powerful but destructive. Simons spent his later years trying to fix what his fund had helped break. That doesn't make him a failure. It makes him human. So ask yourself, if your trading led to power, would you be ready to carry it? You're probably wondering now, can you replicate what Jim Simons did? Can you find your version of the Medallion Fund? The truth is hard to hear. Probably not. But don't let that stop you, because what you can build is something far more powerful. Your own repeatable process rooted in the same discipline, humility, and focus that made Renaissance legendary. You need to face the truth. Renaissance's results came from an unrepeatable mix. Simons had access to brilliant minds, unlimited data, and decades of iteration. Their models weren't just good, they were layered, protected, and constantly evolving. And even then, they broke sometimes. So no, you can't clone it, but you can extract the mindset. You can build systems that prioritize process over prediction. You can track your performance with the same brutal honesty. You can kill strategies that stop working. You can structure your trading around curiosity, not certainty. Because that's what Simons did. He didn't just trade differently, he thought differently. Where others looked for explanations, he looked for patterns. Where others trusted gut, he trusted math. And where others blamed the market, he blamed his model and improved it. That's how you should approach your trading now. Not as a gambler, not as a forecaster, but as a scientist, a builder, an observer of edge. Your goal isn't to win every trade. It's to find what works, test it, track it, and refine it. Over and over, just like Simons. Let's be clear, you don't need 66% returns. You need a strategy that compounds, one that survives uncertainty, one that scales with discipline. That's within your reach if you drop the ego and do the work. Simons did something no one else could do, but he also showed the rest of us what's possible when you take your craft seriously enough to go beyond opinion and dive into evidence. He solved the market in his way. Now it's your turn to solve it in yours, not by copying, but by evolving, by building your own engine, your own edge, your own process, and never falling asleep at the wheel. Because the moment you stop learning, adapting, questioning, you've already lost. So don't aim to be the next Simons. Aim to be the trader who studies harder, tests deeper, and walks away from broken strategies faster than anyone else. That's your medallion. Build it. Word count: Jim Simons didn't trade like anyone else, and neither should you. His story wasn't about luck or insider advantage. It was about relentless iteration, scientific discipline, and the courage to think differently. From decoding enemy messages to decoding the markets, Simons proved that the edge isn't where most people look. It's in the process, the testing, the brutal honesty with which you confront your own thinking. In these 10 sections, you've seen the real blueprint behind the world's most successful trading engine. Not a magic indicator, not a secret setup, but a mindset rooted in engineering your own edge. You learned about building teams that challenge you, systems that evolve, and a culture that values questions more than answers. Now, it's your move. Don't chase Simons's returns. Chase his integrity of process. Build something sustainable, something sharp, something that grows stronger the more it's tested. Start with one system. Test it, track it, kill it if needed. Then build another and another until you're not reacting to the market, you're navigating it. If this opened your eyes, like, comment, and subscribe for more psychology-backed, strategy-driven insights that make you not just a better trader, but a better builder of systems. Let's solve your market.